The fundamental question that we address in our research is to what extent credit rating agencies take climate change risks into account when they formulate their assessments of sovereign ratings. Now, intuitively, they should take these risks into account. There is a big literature that tells us that climate risks are very significant risks for long-term fiscal sustainability. For example, think of a big natural disaster that requires a government intervention. Or you can also think about the adaptation investment, so the investment that is required for countries to make the infrastructure more resilient to these climate risks, or the huge sums of money that will be required for the transition to a cleaner, a green economy. So all of this can have an impact and can affect the fiscal sustainability in the long run of governments. So the key finding of our research is that rating agencies, the main credit rating agencies, have started to take note of these risks, but there is still some of these risks still fly under the radar, so they are not fully incorporated, and there is still some work to do. So if we want to look a little bit more specifically at the individual results, then focusing on physical risk, we find that for physical risk, these risks are broadly incorporated in ratings. Turning to transition risks, on the other hand, so transition risks, they have started to be incorporated in ratings, but only after the Paris Agreement in 2015. But this is important. What we find is also that these risks are not particularly relevant relative to other determinants of ratings. So the traditional determinant of ratings, which are macroeconomic factors, growth, the level of development of a country, the institutional strength of a country, fiscal sustainability variables, external sustainability, they remain the main determinants of these ratings. Climate, they play a little role, but their impact and their role is still relatively minor. So we draw some interesting implications from our findings. So the first is that to the extent that these ratings do not fully reflect the underlying risks from the climate, then a Minsky type of moment, so a sudden reappraisal of these assets, of these bonds, is possible. And then for the institutions that hold these bonds, this could translate into an impact on their balance sheet with consequences for financial stability. Think of insurance and banks, for example, that hold these bonds. So overall, if we can make a recommendations, and it's a recommendation that we make in our paper, that is to be wary of relying too much on ratings for public policies, especially because these ratings do not still fully reflect the underlying long-term risks related to the climate.